Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here. Thanks for checking out the show. Today we're talking about who should be investing in private loans. We get a good amount of emails from people who watch or listen to the podcast, follow us on social, stuff like that, about investing with HMB. And as a lot of people know, we've been full on capital for quite a while. We stay a little heavy on capital. There's always a good bit on the sidelines. And, the investors have been with us for 10 plus years, 10, 15 years. So we don't really actively recruit new ones, but people are asking us about how they can invest in private loans. And as you probably know, we run an inner circle full of a couple dozen really awesome lenders from around the country. So if you are looking to connect with a lending company for that reason, just shoot me an email, chris@hardmoneybankers.com, and I'll point you in the right direction. So who should be investing in private loans? There's a few types that we have identified and been working with over the years. And so one will be high net worth individuals that want something with a fixed rate of return. Right? If you're investing with a company, you're probably going to make around 9 or 10%. The company's probably going to be lending at 12-ish, maybe 13. They'll take a spread. You'll get 9 or 10. That's pretty common. Those are common numbers in the industry. And a lot of people want that. High net worth people want that asset class as part of their mix. I'm sure they have money in the stock market in the form of funds and individual stocks, retirement accounts, things like that. They, in all likelihood, own some investment real estate, also a primary residence with a bunch of equity. That's part of the pie too. And they like the cash flow that comes from those 9 or 10% notes. It's predictable, it's taxable, which is the downfall. We're going to get into some of that too. But it's a good part of your pie chart, right? The pie chart of assets and how you want them. A lot of high net worth people really enjoy this private credit stuff.
Yeah, and if we just did a sample size of who our co-lenders, our capital investors are, can identify a lot of these things based on what personality types some of them are and what their backgrounds are. And, one of the target capital investors, and watching or listening to this in the audience right now, you can probably relate to this, that we have. And there's also folks like this that we've done some private consulting with in the past are, I don't want to say like ex real estate investors, but they had experience investing in real estate, and maybe they still do invest in real estate actively. And, they're looking for something a little more hands-off, or maybe even a little bit less risky, right? A little bit more passive and maybe even a little less risky. And it's like, hey, I had a shovel in my hand for 10 years or 20 years or 30 years. And this was great. I made a good nest egg, flipping houses, buying rental properties, investing in deals, but I just want to be the lender. It's just going to be easier. And, a big component is responsibly learning how to deploy that capital, either if you want to be the active lender yourself and, find the deals and structure the deals and underwrite the deals and process the deals and post-closing, servicing the deals. I mean, it's a full-time business. I mean, take it from us. We do that. We do it every day. We do it every day, and it's big. And, I remember some of our early on capital investors, they understood the game. They understood what we did. They were lending out some of their money themselves. They owned real estate, and they're like, you know what? If I lend out the money myself, that's great. But it's worth just having an operator lend it out for me. I'd rather get a smaller rate of return and not having to do all the hassles. And, there's certainly lenders that we've chatted with and worked with inside the Mastermind group that were the same. Like originally they felt like, hey, maybe I want to run this hard money lending company. And they got to the point and it's like, man, this is hard. Like it's hard to find good deals in and out. And there's a lot of nuances that go with it.
Yeah, for sure. I mean, that's another one that we can add is that you mentioned real estate investors who want to get into something more predictable and passive. There's also private lenders themselves who are further on and towards the end of their career Maybe they're not sourcing deals like before. Maybe they just don't want to do the work anymore, and they're happy to invest with another lender who is doing the heavy lifting. Like imagine if we just thrown out an example, like if we sold HMB, got a bunch of money, right? We sell our lending company, got a bunch of money. We're not actively lending anymore. In fact, we'd probably have a non-compete, so you probably can't even do that. But there's a good chance that we would, instead of getting 12.99 in our own HMB loans like we do now, sell HMB and then invest with another lender at 10%, but not have to do anything at all. That's a pretty good trade-off, right? Like you get 12.99 plus points and you have to do all the work, or you get 10 and you don't have to do anything at all. To be honest, like there's a good argument you can make that the investors have the better end of that deal by having capital. Well, capital can make as much money as your work effort.
Well, we've done the math, and if you're lending out like we are at 13% and 3 points, or 12.99 and 3 points, and we're giving our capital investor or co-lender a 10% return within a 6-month time period, you're making the exact same amount of money. Now, if the money's outstanding, if it's a longer term loan, the capital investor is making more money. If the borrower pays back the loan quicker, you as the operator is making more money, right? Because it's front loaded with points and fees and stuff like that. But like when we created this business in 2007, that's what we kind of felt was the fair way to do it. Was, hey, it wasn't necessarily. Well, there's two sides of it. Number one, what's a good interest rate of return that we attract the right capital investor, right? Because we don't want to necessarily attract a capital investor that's willing to take a 4 or 5 or 6% return, because they're not going to be sophisticated enough. There's other means in order to get to get their money deployed that way. But at the same time, like you can't pay out 15, 16% either, because then there's no room for you. So, that 10% is, it's still a double-digit interest rate of return, or 9 or 10%. It's still a good rate of return, even in today's market where there's higher money market and savings accounts and bonds and things like that. It's still a good return on a good collateral-based asset. But at the same time, you're still, if you're the operator, still making a good amount of money, and you split everything kind of 50-50.
Yeah. So another possible investor target that we have worked with over the years is companies that keep a lot of cash. And we have a couple examples of these who invest with HMB currently, where they, instead of distributing money depending on their their setup as a corp or a pastor or whatever it might be, they end up with a lot of cash on a company level, and they want to put it into an investment to make some additional income to their company, but one that's not going to be locked up forever. It's not the kind of situation where they might want the volatility of the stock market and putting those company funds in for a longer term. And so with loans, like if you do, you have $1 million, you do 200K loans, pretty frequently one of them is going to be paying off, right? They're going to cycle all of them throughout the year. So if you need access to capital, if that company needs access to capital, that can be a smart investment for them. We've seen that work out pretty well with some of our investors. Another one, I have a couple more to go through. Another one is,
let me add one thing on that.
On that one.
Because you mentioned, it's somewhat semi-liquid or somewhat liquid. Like real estate in general is an illiquid asset until you have some sort of equity event, right? A refinance or a sale. And, there's a lot of folks that we know that have high net worths and they have high real estate holdings, but they're envious of private lenders because they have the cash flow. And yeah, they might be making rental returns and things like that, but they've got locked equity that doesn't really help. Now, keep in mind, lending out money is not 100% liquid. You can't access it whenever you need. But it is semi-liquid because the loans are short-term and they're typically getting paid off in a few months or 6 months or 12 months. And if you're in enough of them, you're always putting money out and you're always getting money back. So there is equity events. And I was talking to a buddy that has like 5 million, call it illiquid. Like if he sold his properties, he could have about $5 million. And we were having a conversation and I'm like, dude, well, do the math based on your rental return on these things. Like you're only making like a 3% return based on the amount of equity that you have in place. Yeah, it was value add equity and it wasn't putting cash into that, but it's like, it makes sense to sell those things because he's looking for a higher rate of return on his own capital. And, private lending has that, so I think the we'll just call it semi-liquid is a big benefit.
Yeah, for sure. Okay, on to another one, and that is the retirement account investor. So a lot of people in the real estate world are familiar with self-directed retirement accounts, but in general, people are not. In the general public, people are not aware. They think that retirement accounts only go into stock market and fund type stuff. So bonds mixed in. So this can be either people you come across that you meet that already have a self-directed retirement account, or people who have a traditional type of retirement account and they want to roll some of their funds over to a self-directed and invest in 10% notes that and not pay tax on it, right? So that's a solid rate of return when there is no tax burden like we all get on a personal and company level. And again, it can be a really good addition to the mix for a retirement account, right? Like I think it does make sense to have exposure to the S&P 500, maybe some bonds, and then this kind of private credit stuff. It's paying 10%. That seems like a nice spread. And so, something that we bring up in doing training in the mastermind, online and offline, all that stuff, is that when somebody gets a retirement account, a self-directed retirement account, they also need to source deals. And sometimes people don't have access to good deals. Sometimes also, unfortunately, people end up doing risky stuff and losing money because they don't have deals, and they'll give 100% financing to some, random investor they meet at a meetup group. We see that happen too often. It's a shame. People in that position with retirement accounts should be hooking up with qualified professional lending companies who do good deals. And we have, like, if you don't underwrite deals for a living, you're raising your risk level a lot, and that's unfortunate. People should be hooking up with good lending companies, and we've been, since day one, we've had self-directed retirement account money in our loans, and we continue to. It's probably 20%, 25, so off the top of my head, maybe 25% of our capital is self-directed retirement accounts. It's not a small number.
No,
right?
That's a lot.
Yeah, it's a lot. We work with a few different custodians. Our team here in the office has a good process for getting the funds in and out, because it is a little more work to access those funds and to pay them off and everything else. But I wanted to put that one out there. I got another one or two to go over, but that's a good source. That's something that should be on your radar, whether or not you're a lending company looking for funds, or you have a self-directed retirement account and you got to place it somewhere.
Yeah, keep it going. Keep it going. What else you got?
All right. So the last one I have, last but not least, is who should invest in private loans? You, the lender. You, the private lending company. That's why this niche of business of investing was created, is so that people who had some funds could earn a good rate of return on their money in a safe manner, backed by collateral. Double-digit rate of return. Like, you don't have to, charge yourself a servicing fee. If you're lending at 12%, you're getting 12%. If you're lending at 14, you're getting 14. That's a great rate of return. And the numbers work, whether you have a bunch of money or not. Like, if you're working with 20 grand, okay, not bad. It's going to pay you $200 a month, and that's cool. That's fine. And if you're working with $4 million, then obviously that's some real money coming in, and anywhere in between, it works too. That's something that we think the industry has gotten away from, with all this institutional money coming into the market, and you just sell it off. Like, they're forgetting that this is an investment vehicle, and they're just turning it into a mortgage company, which can work. It can work. If the numbers are good, the bottom line's good, it can be a fine business like that. But let's remember that this is an investment vehicle that you control as the lender, as the lending company, and you can earn an outsized rate of return with complete control over the situation, which is hard to find.
And luckily that's been ingrained in both of our heads since early on. And, I used to have this Warren Buffett quote literally right above my desk in my office.
Yeah, I
and
remember that.
And there was a flood a few years ago, and it got put in the trash, but I should order it again. But in essence, I'll summarize exactly what it said. It was something like, there's not many businesses that are also investment vehicles where you can put your profits and your proceeds back into the business, and it spits out double-digit rates of return over and over and over, and turns into a big compound interest machine, or something like that. And if there are, and if you find one, stick with it, type of thing. And you probably heard us tell this story before. We were in like year 3 of HMB, and one of our biggest capital investors at that time had like a few $1,000,000 invested in deals with us. And, you know, it's good. It's a lot of money, right? But he was making hundreds and hundreds of thousands of dollars on his, 1099 INT every year, which was more money than Chris and I were making. And we were slaving over this business day in, day out, doing everything 24/7. This is year 3, keep in mind, right? We're still at startup, and we were grinding, and he had no idea what deals he was even in. All he was doing was cashing checks one by one. And we're like, God dang it. So that, was a big learning lesson. And like Chris said earlier, this industry has gotten away from that. But this business model is an investment vehicle. And I think, and that's something that we take very seriously. And, we don't, it's one of the reasons we're not just like doing loans to just do loans. Like, we're investors in these deals. We have co-lenders that are investors in these deals with us. And it's had a good return. And we continue to reinvest profits from our business back into loans month after month after month.
All right, everybody, that is the pod for today. Like I started with 2, just a reminder that if you are looking for a solid lending company to hook up with and to consider investing in some of their deals, just shoot me an email. I will point you in the right direction, Chris@hardmoneybankers.com. We'll see everyone here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.